I'm looking at a note you wrote on July 28th. You said our best guess is the markets are currently in the late stages of a selling climax in commodities and commodity-related securities. Looks pretty good right now, but is this really it?
I don't know, Carl. I think we're around there. I don't know if this is the bottom yet or not for sure. I guess that's based on a couple things. The biggest thing is, has the dollar peaked out? Most people think the dollar's going to keep going higher. And if it does, then commodity prices are probably going to keep going lower. I happen to believe the dollar's been in a peaking mode here since March. And I find it very interesting, for example, that despite the fact the probability on the Fed tightening moving up to September has gone up to almost 60%, you got the dollar weaker today than it was, prior to the payroll report last Friday. And commodities are rallying somewhat on that news. I tend to think with a little bit of dollar weakness and with a bounce in not only in the United States growth, but also just globally from all the policy stimulus that we've been enacting, if there's a bounce, then I think commodity price got an excellent chance of surprising everyone and rising over the next year.
Jim, is September the inevitable for the rate hike at this point? I mean, we saw 215,000 jobs added in the most recent month, and now everyone's saying it's September or bust. What changed?
I don't think it's inevitable. I mean, there's just no way it can be inevitable with this Fed. This Fed has been willing to wait as long as it has. We've been growing jobs in this country, 2% a year on year for the last 18 months almost. And unemployment's dropping at 1% a year. There's nothing for sure, but I think we're getting close to whether they have to do it in September and December. I think we're getting pretty close. Whether they do it in September, I don't think it's that big a deal. But what I do think is going to be the pace of which they're going to have to do this, and that the things that I'm watching are embedded, inflation expectations and tips, which are up a little bit today. The dollar, if the dollar goes down rather than up, that's going to put more pressure on the Fed to move quicker. What bond yields do, how fast they move ahead or not of Fed tightening, whether commodity prices actually go up and bounce, and then finally what wages do. And that's a mixed bag as well right now. But I think what's really going to be important for the stock market is the speed of Fed tightening, not necessarily when they started.